Well, good afternoon, everyone. Welcome to today's Fireside Chat with Alfred Johnson, CEO and co-founder of Crux Climate. I'm James West. I run the Sustainable Technologies and Clean Energy team for Evercore ISI. Crux Climate is a digital marketplace that provides access to IRA tax credits. Crux is the ecosystem for clean energy developers, tax credit buyers, and financial institutions to transact and manage transferable tax credits. The company's platform aims to make it easier for companies and organizations to discover the price of tax credits, which tend to trade at varying discounts to their full value. Sellers can then list their tax credits on auction, get bids on those credits, and compare offers. Alfred is the CEO and co-founder of Crux Climate. Prior to Crux, Alfred was Deputy Chief of Staff to Secretary Yellen at the U.S. Treasury Department. Before Treasury, Alfred co-founded a marketplace software company called Mobilize, which was acquired by a portfolio company of Insight Partners in 2020. Before Mobilize, Alfred was head of sales at a venture-backed fintech company. He also worked in the financial markets advisory group at BlackRock, where he advised governments and banks on structured finance and regulatory issues. Alfred started his career working on the Financial Crisis Response and Recovery Act at Treasury and the White House. He's a graduate of Stanford University with a bachelor's in political science and government and an MBA in general management. So Alfred, thanks for joining me today.
Thanks for having me, James.
Absolutely. I think you're doing an incredible service for the industry here. So I'm really excited about what we're going to talk about today. And then for those of you that are listening in to our conversation, if you have questions, which I'm sure you will, this is not a uncomplicated discussion, please do put those in the Q&A box, and I'll be sure to get those over to Alfred. But maybe, Alfred, first, could you share with us the origin story of Crux in the organization's mission, the goals, and the priorities?
Yeah, for sure. So, James, you can't really talk about the origin of Crux without talking about the IRA. It's amazing, but the IRA turns 1 year, 1 week from today, and a ton has happened in the industry since then. It's the largest climate bill ever passed by any government in history. The estimates on the total size of the law vary. The CBO had initially scored it at $369 billion. Credit Suisse came out with estimates last year that scored it at about $800 in terms of total expense to the government. Goldman came out a few months ago and said that actually it'll be closer to 1.2 trillion. So the ever increasing size is a matter of some debate. But what is not particularly debated is the form of the subsidy. About 2/3 of it is coming in the form of tax credits, which are made to be transferable for the first time. And we'll go into this in greater depth, but before the IRA, you couldn't technically sell credits. They had to be monetized to an owner of the project, and the IRA made it possible to sell them. So as you said, James, my background's between government, software, and financial markets. And when I found out about the transferable tax credits, the thing that immediately struck me was, in the absence of a well-functioning market for the transferable tax credits, the haircuts that developers will take on those credits would be quite substantial. And therefore, the cost of capital to develop renewable infrastructure and the things that we need to facilitate the energy transition would go up. So it really struck me as a place that we needed innovation and we needed to build. So I teamed up with my co-founder from the last business, Alan Kramer, and we set out to build Crux. We started by having hundreds of conversations with the market to really understand the problem here. But we're really centering on a central mission, which was to make sustainable finance more efficient and interconnected. Again, if it is the absence of those things, if it's inefficient, if it's not connected, if it's balkanized, the implication is that we're not going to do the level of investment that we need to and that the IRA encourages. So as you said, Crux is the ecosystem for developers, tax credit buyers, financial institutions, and intermediaries to transact and manage transferable tax credits. To break that down into two parts, there are really two things we do. One is powerful workflow tools to reduce costs and headache to transact. And the other is unlock the fastest growing network of buyers, intermediaries, and sellers in the same platform. So we've raised about $9 million in venture capital that comes from great sources. It's Lower Carbon Capital, QED, Canopy, Ardent Venture Partners, Overture, LS, Power, Orsted, Hartree, a pretty long list here, and that's been strategic. We want as many people around the table in this business
Right.
as possible. And we're now 14 and very actively working with buyers, sellers, and intermediaries in this new market.
All right. Well, maybe before we dive into Crux, why do you think that governments are offering this tax credits instead of just funding climate startups directly?
Yeah, it's a great question. It's sort of the essential first order question. So there are obviously a number of ways that governments could choose to incentivize this kind of development. And to be clear, that the US government does offer other mechanisms like loan guarantees. It just turns out that we have used the tax code to subsidize development of energy for a very long time in this country. We started doing that in the 19 teens before World War I with oil and gas.
Right.
And we've just expanded that into renewables, most dominantly since the 1970s, and that's grown over time. But the issue there is that many of the companies that are building these facilities are paid for power over the life cycle of the project and don't have enough tax liability when they earn the credit to use it. And
Right.
so the implication there is that they need to find a partner to monetize those credits.
Understood. Okay, and that makes sense. We do that a major loan program within the DOE that Jigger is running for us today with a lot of capital that I would like to see in the market very soon. So how did the tax credit trading ecosystem change as you looked at it pre-IRA and then of course post-IRA as it sits today?
Totally. So prior to the IRA, you couldn't directly sell the credits. You needed to monetize them to a partner in the partnership. They could only be monetized to an owner. This led to the development of what's called the tax equity market. People on this phone call will be familiar with that. It's a roughly $20 billion market. In the tax equity market, banks and financial institutions make up the lion's share of the provision of capital, the tax equity investors. They're really complicated deals to structure. There are only a handful of firms, 40 to 50, that reliably participate in that market and have the internal capabilities to do that. This market's been around for a couple of decades. It has frozen, James, in a number of instances. So around the financial crisis, it froze. And then more recently around COVID, it froze. And that has to do with the fact that there aren't very many participants in it, and they tend to come disproportionately from the financial services industry. So that led Congress to look at this massive change that they were introducing to the system in the form of many more tax credits on the supply side. And the demand side, as previously constituted, was just the tax equity market. So they needed to figure out how they could increase the amount of demand in that market for the tax credits and created direct transferability in order to supplement the tax equity market. So tax equity isn't going away. It will still be an important tool in the toolkit, but transferability is an important additional mechanism to drive the amount of demand that we need to into the market.
Understood. Well, can you help us quantify how big this market is? You know, how many tax credits could be monetized maybe through 2030, and what do you think about as potential market share as the first mover for Crux Climate?
Yeah, so I talked about the sequence of increasing estimates on the size of the law. A lot of that has to do with estimates about what they assume will be used in terms of the tax credit. So that the credits are uncapped. So as many people come and claim them, they'll be able to use them. The government will extend that subsidy. So if we use the Credit Suisse numbers, which are the most specific on market size, they break down by credit category, how they see it growing over the period that the law is enacted. Credit Suisse has the market growing to 83 billion in annual tax attributes monetized per year by 2031. Just to put that number in context, all corporate taxes anticipated to be paid by all US corporates by the CBO in 2031 is 527 billion. So roughly 15% of the entire corporate tax base in the United States would need to go through the credits to clear the market. So it's a really significant new market that the government has created. Obviously this is going to require a lot of fragmentation in the market. We're going to go from hundreds of projects and 40 to 50 tax equity providers to tens of thousands of projects with credits that are divisible and thousands of buyers on the other side of it. So we really think that software needs to be at the center of that market in order to work as well as it needs to. And critically, we're focused on making that market as big, efficient, and interconnected as we can. So we're particularly focused on the roles that intermediaries play within that market. And that's banks, other kinds of financial institutions, syndicators of the credits, tax advisors. And our view there is that if we can provide them software, then we can enable a large portion of that market to transact efficiently.
Understood. And I'm going to take the over on the Credit Suisse. I guess we can still call them that now, but the Credit Suisse estimates, the firm formerly known as Credit Suisse. I got a question that came in from our audience here that I wanted to propose to you. Is the 45Q tax credit applicable for nature-based solutions like industrial hemp or biochemicals that can sequester and permanently store CO2?
So I am not an expert on 45Q, in part because 45Q will go the direct pay route for the first 5 years before it switches into the transferable market. So I'm not familiar with the specific definition on nature-based solutions there, James.
Understood. I'll try to dig that out for the gentleman who asked the question. Could you maybe give us a brief introduction of the platform that will help developers, tax credit buyers, financial institutions transact? How is the platform set up? What does it look like? If I'm in this marketplace, what do I see?
Yeah, so transferable credits are simpler than tax equity, but they're not simple. There are many underlying documents, lots of stakeholders around the table. So we're building workflow data and stakeholder management software to facilitate the transaction. And that's everything from bid management. So the developer lists a project, is able to intake the expressions of interest and manage the process to close the deal. And then on the buyer side, they're able to search for projects, find them, express bids and interest in those projects, and then close the deal through the platform. So it really facilitates end-to-end that buyer-seller engagement, often with an intermediary that is helping to facilitate the deal on one side or the other. And then we enable our partners to tap into the base of supply that exists within the network. So by virtue of using the tool, your projects on the developer side are exposed into the broader Crux network. You can see bids that come from people that are using the software elsewhere. And what that leads to is a higher base of supply and demand within the product that generates an additional value to all of the participants in our ecosystem that are using our software.
Okay, got it. And then maybe could you talk about some of the key drivers for the business? Obviously, the IRA is the key driver, and the geographical focus. Again, I suspect you're going to say U.S. because it really is the IRA. But just for our audience to help understand, what you guys are doing here.
Yeah, so our focus is the U.S. There's so much activity that is happening here after the IRA. In terms of the core personas or people that we work with, there are really three. So there are developers who generate credits. There are corporate buyers of those credits. And then there are intermediaries like syndicators, banks, and tax advisors that often will stand in the middle of that trade. For renewable energy developers, they're really looking for the best prices, reducing administrative burden to transact. And our tools, Standard Docs and Network, help achieve that. For corporate buyers, they're looking for access to the widest cross-section of the market. They really want to see as much of the market as possible. And so they're looking to manage their internal mandates on tax and sustainability. They're looking to mitigate risk, and they're also looking for standardization so that this is a more efficient transaction. And similarly, our tools and network help with that. And lastly, for intermediaries, they want to leverage their deep relationships. If you're talking about somebody like a tax advisor, they are working with corporates every day to manage their effective tax rate and manifest that in their strategy. So they bring really deep relationships, strong advisory capabilities, a lot of technical capability around these deals to provide services to the market. And our tools and network help them keep supply and demand in balance scale the number of transactions that they're doing and do that much more profitably.
Got it. We have a couple more questions that came in from our audience here. So I wanted to highlight these. So the first one is, I hear many people saying that they are layering the credits with carbon offsets, although relatively small today. Everybody's predicting the offset market to grow significantly. And kind of, I guess the question is, what's your view on that?
Yeah, I think the layering of the offsets with the tax credits is a really interesting theme. I mean, just to like play this out in numbers, if you're a company that has a $10 million tax liability and you buy $10 million worth of credits at $9 million, so make $1 million savings that you wouldn't otherwise have had, you have a choice there. You could use that savings and put it back in your pocket. You could hire more people, or you could advance other sustainability initiatives of the company through things like buying offsets or RECs. So I think there is a complementary nature of the tax credits with those other tradable products like offsets, and the credits should support the further growth of those markets.
Got it. Okay. And then next question from the line, you spoke to the size of the ITC PTC market. What about the depth of demand from buyers, and what are the expected discounts?
So this was it's been a really interesting journey on this. The company is, 6 months old or something like that. And for most of the existence of the company, we have had much more supply, meaning people looking to sell their credits, than we have had demand.
Right.
And of course that makes sense, James. Like these developers have the credits, they've earned them, they want to get the highest price for them. I'll come back to the pricing question in a second. Sure. We have seen less demand from buyers coming to the market and wanting to buy in the first half of this year. And part of that has to do with the fact that Treasury had not yet put out guidance on the market and how it would function until the middle of June. Right. And a lot of buyers were waiting for that. For the first time recently, we actually now for 23 have more demand than supply. And that highlights that there's both more buyers that are coming into the market, more corporates that are waking up to the opportunity here. And also this point that supply demand imbalance is actually hard. And you'll see dislocations of supply and demand in a given year, across years. And that's one reason why we think that the model that we have chosen here makes a lot of sense for intermediaries, where even if you're a large bank, a large tax advisor, you may not always have marketplace balance. And being able to access the other side of the trade is really important to you. So I think there's like a definitive trend in the direction of many more buyers participating in the market, but there are always going to be these little imbalances that need to be corrected. And that's one reason why we need the larger market.
Right. Understood. And any view on the discount side?
Yeah. So pricing is interesting. In the early deals, we're seeing pricing at the 88 to 92 cent range on ITCs. They're a bit higher on PTCs. The PTCs, production tax credits, don't carry the recapture risk that investment tax credits carry. And so they're trading at a premium in the market. I think in general, we're going to see pricing range from the high 70s, mid to high 70s, up to the mid to high 90s. At the low end of the range, you will see things like smaller developers, smaller projects, more novel technologies, more uncertainty around the adders that are associated and being claimed on the credit, the absence of insurance, things like that. And towards the high end of the range, you'll see sponsor-backed developers or credit-rated developers that are very large, that are selling either ITCs with a very strong guarantee or insurance associated to them, or they're selling PTCs. And I think one thing about pricing that is not as much a part of the conversation as it should be is I do think you'll see some intra-year volatility and variability in pricing, because supply and demand aren't always going to be constant, right? Towards the end of the year, you might anticipate that more demand will come to the market that would push up pricing. If there's macroeconomic weakness and the tax base of the US is lower, then there's less demand. So I think you'll see some variability in pricing, but generally that's the range that we're anticipating.
Got it. Okay. Well, you're generating a lot of questions from our audience here. We got a very high quality, interested audience. So two questions real quick. Can you define smaller, as you said, around the pricing? And then an example, what is a high quality carbon credit? Maybe provide some examples if you could.
Yeah, so this is such a complicated space because there are all of these things that sound very similar that are different. And the three that I have mentioned, mostly I've been talking about the transferable credits. The transferable credits have varying ranges of perceived risk that are mostly associated to the perception of the risk of recapture by the buyer. So the buyer is subject to recapture risk, meaning that if the credit, for example, was claimed on a higher basis than the IRS later determined was appropriate, then the IRS has some ability to go claim the difference between what was claimed by the buyer and what they believe the actual value should have been. And that risk is borne by the buyer. So you see that play out in diligence, you see that managed through things like insurance. And that's what I mean when I talk about the perception of quality within the market. It's basically the perception of risk within the market. And so the reason that I make the point about the different things that are tradable here and how they relate to each other is you also have renewable energy credentials. There are different perceptions of quality on RECs, and you have voluntary carbon credits where there are different perceptions of quality. Those products, I think, as I mentioned before, will often trade alongside the tax credit, but are different products. And there's different notions of quality within each of those markets.
Okay, great. And then the other question about smaller, when you mentioned smaller around the pricing.
Yeah, so in general, I think we're starting to see a line around $5 million ITCs. Now, obviously, they can be split into lots of different pieces. The reason I call out 5 million is that's the level where we're starting to see insurance pricing start to become prohibitive. So in general, insurance on ITCs is running in the neighborhood of 2 to 3% on the credit basis. To fully insure it, you would pay as the seller another 2 to 3 cents on the dollar for insurance. The reason that's an interesting product is back to the perception of risk by the buyer. Many buyers are saying that they just want to buy insured credits. And so it's worth it to the seller to go out and get that insurance. The $5 million number tends to be the number where the costs of insurance become pretty high. And so it's not that stuff won't trade. It will just probably trade at a deeper discount or with higher insurance costs associated to it.
Right, got it. Well, maybe could you provide some examples, if you have any, of successful clean energy tax credit transactions that you guys have facilitated and the positive impact of these transactions on both investors and clean energy projects?
Yeah, so we have facilitated what we believe is one of the first transactions in the market that is now past the term sheet stage. It's a sub $5 million deal, actually, just sub $5 million deal. It is insured. The seller is a community solar developer. The buyer is a small market cap public company who had not previously participated in the tax equity market, but had participated in the low-income housing tax credit market. So had some familiarity with tradable tax credits. And the really interesting thing about that deal, James, is it's the sort of thing that wouldn't have happened prior to transferability. That credit would have had to be portfolioed among others in order to get tax equity at favorable rates. And the buyer had not been previously participating. So it indicates that both the buy and the sell side of this market will be more fragmented than previously possible with the tax equity market. And that's really encouraging for our ability to build more clean energy infrastructure.
Understood. And we got a couple more questions from the line here. You're generating a lot of questions here. How exactly does having insured credits provide value to a prospective buyer?
It's really just the way in which risk is managed. So I talked a moment ago about the risk of recapture. The guidance specified that certain risks associated with recapture are borne by the buyer, not as many risks as were previously anticipated prior to the guidance. So the guidance was somewhat favorable from that perspective, but the buyer still owns some of that risk. And again, the risk there is that the IRS later assesses either a penalty or determines that the basis that the credit was taken on was inaccurate, and the buyer is subject to that risk. There are a number of ways of managing that. You can buy production tax credits that don't have the same risk of recapture. You can rely on the indemnity that is provided to you by the sponsor or the development company that is building the credit and has the credit. And in many cases, depending on the credit worthiness and the balance sheet of the sponsor, that may be sufficient. And you may rely on insurance. And if you rely on insurance, you're paying something in the neighborhood of 2 to 3%. And you have an insurance company that is doing the diligence and validating and wrapping the various elements of risk associated to that. And if you're a buyer, many buyers here are tax directors of companies. Most are public companies, but not all are public companies. They don't manage a P&L in the same way that people at a financial services firm might manage it. They're responsible for the tax rate of the company and would like to align to the sustainability targets of the parent and the goals that the company has set. But they want to make sure that their risk is protected here. And don't necessarily have, internal deep project underwriting experience. So they're either leaning on diligence and other service providers and or insurance to make sure that they are protected from unforeseen risks associated with the project.
Okay, understood. And then another question about kind of your clients or customers here. Are family offices contributing, and could they be an important slice of the future demand for transferable credits in addition to corporates? And are you working with any, or are you seeing any in the market today?
Yeah, so James, this is a matter of hot debate in the market right now. It had been expected or hoped by many in the market that Treasury in the guidance would take a more permissive approach to the active passive rules. The general limitation here is that you can use passive credits against passive income taxes, and passive income taxes tend to be associated with real estate ownership interests in private companies, things like that. But it's not active income, and it's not portfolio income like income associated with stocks and bonds. It is a third category of passive income that tends to be a minority of the income tax that is paid by even ultra high net worth family offices. There are obviously some family offices that are disproportionately allocated to things like real estate that have enough of the right category of income to be able to take advantage of the tax credits. And some of those family offices are beginning to look at the market and have enough of a tax base and liability that it will make sense for them. In general, we think that the market on the buy side will mostly be corporates. That doesn't mean that there won't be some participation here. I just think when you look at the $83 billion supply number, most of that is going to go to corporates who are able to use the credits to offset any federal income tax. And so it is inherently less complicated. The reason I said it's a matter of debate is because the Treasury Department in the guidance that generally took the more restrictive approach here and validated that the passive activity rules apply. The Treasury did say we would welcome comments on instances where it would be valuable for the rules not to apply. So they opened the door a little bit to comments on that. I know that many are writing comments on that. I'm not overwhelmingly hopeful that they will dramatically change their position on it, but that represents sort of an upside to the market in the case that they were to interpret that individuals and family offices could participate more broadly.
Okay, understood. Well, we know that Europe traditionally has led the way in energy credits and tradable offsets, at least over the last decade. Do you see that the green credit market investment shifting now to the U.S. after the IRA? And are there any new or ESG related markets that don't exist now that you kind of see developing in the future?
Fun questions. Yeah, so the IRA is so catalytic to the U.S. market. It could not be more of a tailwind here. We've talked about the size of the transferable credit market, the ways that companies will be using the credits. I think you are going to see this behavior that we talked about earlier, where offsets and credits will be paired together. Savings will be generated by the tax strategy that is deployed into other tradable products like offsets. We see a clear opportunity there. In time, we will facilitate those kinds of blended deals. And that starts to get into what I think the market will do and other products that I think will emerge. I think categorically, you're going to see more configuration of shopping carts, right? It used to be harder to do that kind of thing, where you would look at the goals of the company across sustainability and tax, and pick some tax credits and some recs and some offsets and some investments that you might make into different parts of the business. And now companies, I think, have many more tools to be able to figure out what the right strategy is for them that wasn't previously possible. I think as far as new products here, I think there's an interesting observation about the extent to which the existence of the tax credit regime will enable more data on these projects than previously existed. That has historically been a limitation on things like green bonds getting the adoption that they could. And I think with the tax credits, you're gonna necessarily need to collect a lot more data on production, on the components of the investment. And that, of course, relates to the E side of ESG. Interestingly, it also relates to other aspects of the projects, right? You'll have to track whether there was domestic content that was used in the project, what the composition of labor that was paid the prevailing wage or was union affiliated. And so I think we're going to have a lot more information on the ways in which projects are designed, created, and completed in the United States. And that provides us a lot of mechanisms to corporates to better manage the ways they're engaging in these markets.
Yeah, that's highly interesting. The question for the line that came in, does Crux handle the trading of nature-based carbon offsets that have been validated and certified by a third party?
No, we don't handle those transactions. We are talking to companies that do, and there's the interesting coherence of the products, but we don't currently offer those offsets. Okay, got it. So there are a number of competitors in the energy trading markets, which you have been a part of in the past. But does Crux, or how does Crux differentiate itself from these competitors, and how do you plan to maintain your competitive edge? Yeah, so it turns out that when the government creates a new $1 trillion asset class, people notice. I wish that weren't the case.
Right.
People go on webinars and they talk about it, and other people start to do it. So there are obviously a number of existing and new firms that are thinking about how they're going to play in this market. We're really focused, James, on the enablement of the ecosystem. You asked at the beginning what the mission of the company was. I said that it was to make sustainable finance more efficient and interconnected. We take that really seriously, right? We don't just want to build a brokerage here. We want to build the platform in the ecosystem where the participants across different categorical types are able to benefit from participating in the same market. And I think that makes us different versus any of the competitors. We're really trying to be the software layer and are actively working with intermediaries to help them unlock this market. And as far as maintaining the advantage that we have in the market and continuing to build on it, we've raised quite a bit of capital for an early stage company. We've raised about 9 million. That comes from great sources, as I talked about earlier, including strategics here. That has enabled us to build the team quite quickly. So we're 14 people. That's roughly half on the engineering side and then half on the market facing and marketing side. And with that size, I think we're able to be in a lot of deals faster and build product that is actually useful faster. And those values and advantages will compound.
Got it. And then maybe that leads to my next question, actually, about the financial health and stability. At this point, are you guys fully funded?
Yes. This is funny. With the last company that we successfully sold, we had to fight for every, $25,000 check in that. Fundraising for this early company has not been that same experience. We've had a lot of great partners who've wanted to participate here. So we did 2 rounds of capital. We did 4.6 million in the first one, Lower Carbon led that one. And then we added another 4.25 million that Ardent Venture Partners led, and we brought the strategics into that. So LS Power is in that one, Orsted, Canopy, Hartree, others like that. So we're in a really good financial position to be able to grow and be aggressive in this market.
Got it. And then can you talk a little about the scalability of the platform and why this is an important focus for the company?
Yeah, so fundamental background on scalability is this market is about to grow by 4 times, 5 times, 6 times, depending on what your guess is here. It's about to dramatically increase in volume. It's also going to exponentially increase in terms of fragmentation. So, it's just a different problem than the market was previously facing. Our primary business is enabling intermediaries, but we have put deals together. And one thing we have found, even in putting these early deals together, is that there's a lot of administrative burden. There's documents to be shared, there's information sharing, there's managing confidentiality. There's a lot of complicated pieces of that. So our key drivers for meeting those challenges are technology that helps create and drive transparency, reducing the transaction costs here. Again, if this is so expensive to transact that people don't want to participate in the market, we're not going to build as much as we need to, as quickly as we need to. And we need to make it easier to build trust at scale, right? We're going from a market where you could depend on a single tax equity provider or a handful of known counterparties to maybe selling transferable credits to more counterparties on the other side of that. And managing that kind of complexity is really hard without having dedicated tools to be able to do that. So we're really focused on building the ecosystem in a way that provides efficiency and transparency into the market.
Understood. Okay, and that makes a lot of sense. What is your customer acquisition strategy at this point? I know when you guys kind of flipped the switch, you had a lot of seller demand, and now we're starting to see buyer demand. But how do you think about customer acquisitions?
It really starts with education, James. It's a brand new market. Mm-hmm. People are just starting to get their heads around it. And, again, if you think about the corporate tax director side of the market, this isn't a category of financial product or asset that they have much experience looking at. So we're starting with, conversations like this one, trying to meet firms that might participate in the market and teach them about how this is going to function. We're producing quite a lot of content that relates to the way that the market is going to function, the rules that will govern it, things like that. And then tactically, we're trying to get this content in front of as many people as possible. So we're doing digital ads, email outreach, social media, SEO, and a good bit of press. We found that the press coverage that we've gotten as a company has generated a lot of inbound interest. So that's been a productive thing to do, particularly as reporters are also trying to understand and participate in this new market. Right. And we're really open for business. So if there's anybody who's looking to buy, sell, or syndicate credits, we'd love to hear how we can help.
Understood. And then how are you, or have you been establishing? I guess you have key investors that are some of their major supporters, and then you have some partnerships. So could you maybe talk through about how you're thinking about the companies, investors, and government entities that you're going to partner with or take investments from, and kind of how that plays into the overall strategy of the company?
Yeah, our view really is that if we do this right, we convene stakeholders on the buy, sell, and facilitating side of the market around the same set of software. And so we have used our early fundraises to bring some of those partners around the table, and also signal to the broader market that is our approach and intention. We have a number of other partnerships that are cooking that we haven't yet announced, but are very actively developing, and in some cases have a form of commercial agreement with. So we're moving quickly on the partnership side. We do find that we exist within this ecosystem of service providers, right? It is not like people aren't seeking legal opinions or advisory opinions on the deals that they're doing. And so we see a lot of opportunity to put leads in other people's inboxes, and other people are sending people our way. So, we really think about actively cultivating the network of people around the company. With the government, we are focused on building the platform that is most conducive to the goals of the government and aligns best with the standards and the rules that the government is putting in place. We think if we do that, we will best enable the market, again, in a way that the government sees as conducive to their goals, and that's good. So that's really how we've thought about partnerships. As far as capital allocation strategy, we're really focused on people, right? Software is just a thing that people build. We need to build the right things as quickly as possible, build the right relationships as quickly as possible. And that's where we're spending our time and our money right now.
Got it. We have another question from the line. Hypothetically, if corporate tax rates were to rise in the future, what would you expect the tax credits to? How would these trade? Would they trade above a dollar of book value?
I think you would need other dynamics to support the credits trading above $1 in book value. So you see sometimes in the LIHTC market, credits will trade effectively at $1, at more than $1, because the banks are taking advantage of the CRA points that they're getting for those investments. I think you would need some characteristic like that in order to drive pricing north of $1. I think in general, anything that would lead to more corporate taxes being paid should be supportive to the demand side of the market. And that could be the economy is going gangbusters and corporates owe more taxes. It could be that the tax rates increased and therefore they're looking for more ways to offset them.
Understood. Okay. And then regulatory compliance has always been a complex issue in commodities markets, but could you discuss how Crux is thinking about, or you're thinking about, managing regulatory compliance and navigating what is an increasingly complex environment?
Yeah, so the tax credits are credits, not commodities or securities. And that said, our work is highly related to the goals and objectives of the government. And so our approach to navigating regulatory and government-related complexity really falls into two categories. One is directly. So we have addressed the inherent regulatory and compliance complexities by working with law firms to develop things like standard documents to enable these transactions. We have deal checklists that we're bringing to the table for buyers and sellers to help make sure that they are looking at the right information and understanding it. And then building transaction management tools and reporting into the product to ensure that everybody has the necessary information, both at the time of transaction and on the buyer side after the transaction is closed and while they are still subject to compliance obligations there. And then indirectly, our platform designs, anticipates, facilitates efficient coordination among the various parties around the transaction. And that includes people like external legal counsel, tax advisory firms, people that need to weigh in and opine on the credit basis, so that the software accommodates those kinds of service providers playing that role efficiently within the transaction.
Got it. Okay. And then last question for me, Alfred, what are the short-term and then the long-term growth strategies for the company? Could you talk about the vision for expansion, product development, market penetration in the coming years?
This is such a exciting space. There's so much money that is flowing into renewables development and decarbonization, and it couldn't happen a minute sooner from a mission and importance perspective. So we think there's just great tailwinds behind the space here. The market for the transferable credits is going to grow a lot in the coming years. We need to be the winning platform there to facilitate the version of the market that we want to see that will make it most efficient and interconnected. So we are really focused on providing that software and building that liquidity layer among buyers, sellers, and intermediaries. Outside of the transferable tax credits, we see them as so central to project development. It's this very important piece of the capital stack of the development, right? Roughly 30% on average is coming in the form of tax credit. But there's a lot of things there's other sources of capital that are outside of that credit. For example, the financing of the project, the equity into the project. And we see opportunities to either facilitate or enable those kinds of fundraising into the project. So things like facilitating bridge loans into projects and helping them to bridge the gap between when they need financing and when the credit is generated. We also see the opportunity to start to bridge into other kinds of tradable products. So we talked about RECs and offsets here, given the buyer behavior that we've talked about, that where they may want to buy the tax credit and then use that as a financing mechanism for other sustainability initiatives. So we think there's a lot of opportunity that sits one click outside of the core market here. But with any startup, the way that you die is by lack of focus. And so we need to make sure that we are firmly pointed on the thing that we are here to do, which is to provide the efficient market in the transferable credits. And then from there can build into these other areas. And when we do that, the direction that we're going is to build an integrated platform for renewable finance. And I think that's very necessary right now, given the scale of investment that's about to happen.
No doubt about that. Well, look, Alfred, thanks for taking your time today. I know I told you 45 minutes, so in a few minutes over, but a lot of exciting stuff happening in the marketplace, certainly with Crux Climate as well. So we look forward to watching your continued progress and hope to talk again soon. So thanks for joining me today.
Thanks for having me, James. Bye, everybody.
Absolutely. Take care.